What is the long-term sustainable growth rate for a company? What growth rate is the market currently pricing into the stock? What growth rate are analysts expecting for the company? And given all of the above questions, within the context of the macro market risk appetite, what is the fair intrinsic value of the company's stock? These and other related questions can be answered using the unique tools available in the Zacks analytic framework to identify significant long and short opportunities in the U.S. equity market. Today, we will utilize these tools to highlight a potential short opportunity we see in the stock of Hasbro. We begin with the Zacks valuation model by clicking at the tab at the top of the ZRS toolbar, labeled Valuation Model. The Zacks valuation model is a visually oriented 5-factor discounted earnings model that draws from the intuition of the classic dividend discount model. The default starting point, as you see here, uses inputs derived exclusively from Zacks consensus sell-side earnings per share estimates. No subjective adjustments are made by Zacks analyst staff. This valuation model can quantify any combination of earnings forecasts, earnings growth forecasts, equity risk premium forecasts, interest rate forecasts, and company-specific risk issues. Let's begin by taking a look at what growth rate is being priced into the stock as of today, Wednesday, September 16th, 2015. We can achieve this by clicking on the MIG button on the top left side here. You'll now see that the resulting growth rate at the very top is 10.25%. This is the implied long-term sustainable growth rate that investors are currently pricing into the stock. Next, according to the Zacks consensus forecasts, Hasbro is expected to grow by 21% in 2016, followed by a tapered 6% in the following year of 2017. This is driven by 7 and 4 analyst estimates, respectively. We also note that Hasbro is currently rated as a buy, according to the Zacks rank. The Zacks rank is our flagship alpha model that measures the strength of underlying estimate revision momentum, indicating further upward analyst revisions in their earnings forecasts are likely. You can visually see that Hasbro stock has delivered stellar returns since 2011, and this has been driven primarily by a PE multiple expansion. As you can see, the stock chart outpacing earnings growth. Indeed, if we look at the PE chart, Hasbro has went from a PE of 10 to a PE of over 20 currently, which represents over a 1 standard deviation move to the upside relative to the long-term average of about 15.5 times earnings. Despite the rapid PE multiple expansion, we can see here that the Zacks growth style score is currently rated as an F. These style scores are a composite score based on 10 different factors as shown here below. These style scores can be accessed by clicking on the Estimates tab and selecting Zacks Alpha Scores. Returning back to the point that Hasbro has experienced significant PE multiple expansion since 2011, the natural question comes to mind. Has Hasbro traded at these multiples in the past? Let's refer to the Zacks Equity Risk Premium chart to answer this question by selecting the Custom tab, going under the Zacks Default Templates, and selecting the Zacks Equity Risk Premium. As we can see here, the last time Hasbro stock reached PE multiples in excess of 20 was all the way back in 2002, 2001, and 1999. Here's where we see something truly interesting. The equity risk premium when Hasbro stock last reached these levels of 20 times earnings was somewhere between 1 to 1.5%. Without there being some large-scale reinvention of Hasbro's business model, its current valuation of 20 times earnings is completely out of sync with today's equity risk premium of nearly 4%. Hasbro's licensing agreement with Disney over Star Wars toys would not constitute a reinvention of their business model. Secondly, note that the similar elevated PE was observed in 2006, as we can see here in this chart, but it was also rapidly followed by a decline in multiples thereafter. As forward price multiples are normally a function of the company's growth and profit margin prospects, let's take a deeper dive into both of these items. We can do this using the growth and margin view found under the Financials tab. The first point we observe from this table is down here on the bottom left-hand side. Annualized top-line revenue growth, as measured using the least squares methodology, has never been able to sustain and support growth of more than 3% over any time period, be it over 1 year, over 3 years, 5 years, 10, 15, or 20 years. Similar results are found over the most recent 8 quarters, as you can see in this column, with revenue growth on a trailing 12-month basis clocking in at precisely 3%, with a marginal uptick of 4% over the next 4 quarters as projected by analysts. Contrast this 3 to 4% growth figure with the 10.25% that we saw in the valuation model, as the rate that we uncovered as the implied growth rate priced in by the market currently. If you believe that earnings growth ultimately can only be supported by revenue growth, then 10.25% is significantly over Hasbro's long-term sustainable level of 3%. Perhaps the market is therefore pricing in profit growth due to margin enhancement more than top-line growth. Well, let's take a look at Hasbro's profit margins to see if there is some evidence of margin turnaround. Zacks' pre-built concise chart is designed just for this, and is found under the Custom tab back under Zacks Default Templates and Zacks Margin Analysis Absolute. Hasbro's margin cycle, neatly summarized in this single view, suggests that there are rough waters ahead. First, year-over-year percent change in revenues, seen in the top panel up here above, has already begun rolling over. Even though forecast revenue growth increases to 9% in 2016, this is likely due to short-lived product cycle, and we will see revenue growth normalize back to long-term trend averages of just about 3%, as we saw in the previous chart as well. Secondly, gross margins, operating margins, and net margins are all delivering all-time high profitability, which suggests that further cost-cutting to offset any potential revenue decline will become more and more difficult without making cuts to critical resources. Thirdly, operating margins have been expanding to its peaks previously seen in 2007 and 2010, with a history of Hasbro not being able to achieve margins much higher than its current 15%. Fourth, net margins are similarly at its peak previously seen in 2010. And finally, fifth, gross margins are at all-time highs in the face of declining revenue growth. From this, we can effectively postulate that Hasbro is not in a position to enact further cost controls to combat sluggish revenue growth, putting its current 8 to 10% earnings growth in jeopardy. Thus far, we have failed to identify justification for Hasbro's 13-year high PE multiple, expanding from 10 times earnings just 4 years ago to over 20 times earnings currently. Because valuation is often driven by intangibles or business segments that operate in untested markets or industries, such as in Tesla or Fitbit's case, we can turn to the Zacks independent research to identify whether Hasbro has any exposure to such uncharted territories. To access our award-winning independent research, click the Research tab, and under Equity Research, select Analyst Report. If we have coverage of the stock that you're looking at, you'll see the report display immediately, as you see here. We know that Hasbro's largest and most important segment, the boys segment, has only been able to post growth of 1% year over year, while games, girls, and the international segments all declined by large percentages. Looking ahead, management has also issued guidance of higher operating expenses, which coincides with our earlier analysis of a risk of declining profit margins. This leaves the Hasbro's Toys category under Star Wars, The Force Awakens brand, to be the last and final potential source to uplift the company's revenues while maintaining their already high profit margins. As the research note states, Star Wars The Force Awakens products entered retail in September 2015 with hundreds of varieties of Hasbro's toys. The theatrical release of Star Wars The Force Awakens is scheduled for December 2015. These productions are expected to attract children to movie-inspired toys and thereby boost sales. The company intends to continue to launch new Star Wars products in 2015 as well as 2016, given customers' interests. So our final question is that, given the fact that Hasbro, on a discounted earnings analysis, is overvalued, with an implied growth rate in excess of 10%, with revenue growth having never exceeded 3% over a long-term basis, and whose profit margins across the board are hitting multi-year highs, with management also issuing warnings of increasing expense ratios, are the Star Wars branded toys enough of a revenue driver and the primary investment thesis to justify forward PE multiples of 20 times? We do not believe so. With that, we hope the tools and research available in the Zacks Analytics platform, as highlighted in this video, and white paper evaluating Hasbro, continue to add value to your analytic research process. If you have any questions or would like to perform a similar analytic exercise for any stock of your choice, please feel free to